And don't worry that $4,000 gold or $50 silver seems expensive. It only looks expensive compared to where we were. But compared to where we're going, it's going to look real cheap. You own the gold, and the token is evidence of that ownership. It's like a warehouse receipt from the blacksmith, except it's on a blockchain and it's a token. But now you can use that token. You can send it to somebody else. And when you do, you're sending them ownership of your gold. And of course, it's divisible. So if you have, $10,000 worth of gold and you want to send somebody $100 worth of it, right? You don't send them all of your tokens. You just send them whatever you need to equal $100. And now that gold is no longer owned by you.
In this video, renowned economist and market strategist Peter Schiff breaks down why today's prices for gold and silver, no matter how high they may seem, are still cheap compared to where the market is heading. He explains that many investors judge metals by past prices instead of future reality. What looks expensive at $4,000 gold or $50 silver will appear like a bargain once the monetary system resets and true value reemerges. The discussion highlights a major shift in how precious metals can be used and exchanged. Instead of relying on traditional storage receipts or bulky paperwork, modern blockchain-based tokens now act as digital warehouse receipts that represent real, allocated gold. This means holders maintain ownership of their physical metal while gaining the ability to transfer any fraction of it instantly and securely. Whether moving $100 or $10,000 worth, the ownership transfers seamlessly, giving precious metal holders unprecedented liquidity and control. As global debt, currency debasement, and financial instability accelerate, this new structure positions gold not just as a safe haven, but as a functional, divisible, and globally transferable form of real money. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview.
Right? If gold is performing this well, if you've got a 50% gain in gold, who the hell needs fool's gold? I mean, why would you have to give up real gold that's doing so well to take a chance on fool's gold, right? Before, the Bitcoiners were able to promote Bitcoin because gold wasn't going anywhere. But now gold is. Remember, they were saying Bitcoin is going to be the fastest horse in the race for the dollar debasement trade, for an inflation hedge. Well, it's getting killed. People in Bitcoin need a hedge, right? It's de-Bitcoinization, not just de-dollarization. People are getting out of that. And people are also getting out of tech. So I think everything is going right for the precious metals trade because all of the problems that it really was plagued by in the past are going away. And I think it's clear sailing. I think the central banks that have been buying gold all year are going to buy more next year. And a lot of central banks that haven't been buying gold, they're going to start because they can see how successful it's been with all the other central banks. The Bitcoiners were saying that all the central banks were going to have to race to buy Bitcoin, right? That was going to be a Bitcoin arms race started by the U.S., but everyone was going to FOMO in to Bitcoin. It's not Bitcoin, it's gold, right? The central banks that have been buying gold are the winners. And in fact, now this year, the percentage of central bank reserves that are in gold is now higher than U.S. treasuries. And this is the first time that's been the case in a couple of decades. And so the central banks that already made the decision to buy gold, they're doing great. And I think that's going to result in bigger buys of gold by those banks. But now other central banks that weren't buying gold realize that they need to buy it because they're getting left out. The FOMO is not about Bitcoin. It's about buying gold. And so you're going to see that, but you're also going to see private investor demand, I think, in 2026, like we've never seen, because people are going to look back at 2025 in early 2026 at the spectacular returns in gold relative to equities, relative to crypto, right? Relative to everything. And people are going to get invested. And again, Morgan Stanley came out and said we need to adjust the 60-40 portfolio. We're going to cut the bond allocation in half and replace it with gold, which again shows they don't view gold as risky. Otherwise, they would have reduced their equity allocation. They reduced their bond allocation. They said, sell half your treasuries. That's where the risk is. Get out of half your treasuries and put the money into gold. From 2011 to 2014, gold really didn't go anywhere because it didn't get above 2000 until 2014. And that was about the peak from 2011. So it was during, that dozen-year time period where gold holders were frustrated by the failure of gold to make any, new gains, that Bitcoin was able to really steal the show by convincing a lot of people that it was the new gold. After all, look at this spectacular appreciation. Bitcoin keeps going up. Gold doesn't go anywhere, right? So Bitcoin is taking gold's place. It's better than gold. It's gold 2.0. And the markets kept, reinforcing this up until this year, right? This year, gold is up better than 50%. And I don't know, Bitcoin is down over 5% or something like that. Bitcoin is 85,000 as I'm talking. When I recorded the podcast last week, it was still over 100,000. Bitcoin dropped 10% on the week, or maybe it was, just below. The low today was under 82 before we got a rally back. No, exact below 81. Bitcoin earlier this morning got to 80,537. That's on Bitstamp. We were at 126 not too long ago, like a month or something. So you're talking about a 35% decline in Bitcoin in dollars. Against gold, it's 43%. This is a massive bear market. But Bitcoin is far more correlated with tech stocks than gold. And if tech stocks have peaked, if we're going to have a pullback, a correction that's just getting started in tech stocks, the bear market that is already well underway in crypto.
In this video, one of the most outspoken voices in global finance breaks down a major shift in the battle between real money and speculative assets. For years, cryptocurrencies gained traction by claiming to be digital gold, especially during periods when precious metals looked stagnant. But with gold surging over 50% this year and repeatedly outperforming every major asset class, the narrative has flipped entirely. The discussion highlights how the conditions that once allowed Bitcoin to overshadow metals have now disappeared. Gold's breakout is forcing investors to confront the reality that real, tangible value is returning to the center of the global monetary conversation. Meanwhile, Bitcoin is experiencing sharp drawdowns, over 35% from recent highs, mirroring the weakness already unfolding in tech stocks. The correlation between crypto and tech is tightening, exposing both to the same risks. At the same time, central banks around the world are accelerating their gold purchases, even outpacing their holdings of U.S. Treasuries for the first time in decades. Institutions, private investors, and global policymakers all appear to be positioning for a future where gold regains its role as the ultimate reserve asset. As traditional portfolios shift away from bonds and toward metal allocation, the momentum behind gold looks stronger than ever. Let's get into the interview.
Holding near $50, that's the breakout level. That's the old double top. So gold and silver holding up very well in the face of all of this market volatility. Part of it, though, is coming out of Japan. Part of the liquidity squeeze, the yen carry trade, the new Japanese government announced a massive new fiscal stimulus where they're going to be mailing out stimulus checks and doing some other stuff, right? And, these stimulus plans are all misguided. They've been making lots of mistakes in Japan, just like we make mistakes here. Although the Japanese stock market has been doing great, although all the other stock markets got clobbered last night as a result of this and what's been happening to Japanese government bonds. In fact, the 10-year JGB, the yield got above 1.8% yesterday. It backed off a bit today. I think we settled at about 1.77. But 1.8 was like a 20-year high. I forget exactly. But I've been talking on my main podcast at, the Peter Schiff, not on so much on the Schiff Gold, although I probably mentioned it. But I've talked a lot about the yen carry trade and the blow up of the Japanese government bond market. And that's what's going on. Because when this started, the yield on 10-year Japanese government bonds was less than 50 basis points. And I remember when, they had a line in the sand there, they were trying to hold the yields below 50 basis points. In fact, they were quite a bit below at one point. And now they're more than triple that. I think once we get above 2% in the 10-year Japanese government bonds, you're going to see, some real fireworks in the markets, not just in Japan, but all around the world. But it was interesting because the government came out and said that even though they're doing this massive stimulus, they don't anticipate increasing the issuance of, Japanese government bonds.
In this segment, the discussion turns to the global volatility spilling out of Japan and reshaping the precious metals landscape. While gold and silver continue to hold near critical breakout levels, especially with gold flirting around the historic $50 resistance, another force is now shaking global liquidity: the unwinding of the yen carry trade. Japan's newly announced stimulus program, complete with direct payments and expanded fiscal support, may sound supportive on the surface, but it's triggering deeper instability beneath the financial system. As yields on Japanese government bonds surge toward multi-decade highs, cracks are becoming impossible to ignore. The move from under 0.50% to nearly 1.8% on the 10-year JGB marks a seismic shift in a market once defined by ultra-low yields and aggressive yield curve control. A break above 2% could ignite turbulence far beyond Japan, potentially hitting currencies, equities, and global bond markets simultaneously. This tightening liquidity environment is helping push investors toward real assets, strengthening the case for precious metals even as broader markets struggle to find footing. Throughout the chaos, gold and silver remain the quiet beneficiaries of a world adjusting to the end of artificial stability. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.